Hey everybody, thank you for coming back and tuning in. So I wanted to speak about the events on November 10th where the stock market rallied. And it was due to inflation being quoted at 7.9%, which was significantly lower than the over 9% inflation that was quoted in the past. However, if this was just at the beginning of the year, 7.9% would have still been considered historically high, although people are now celebrating that inflation went down to 7.9%, and they assume that the worst is over. And so the stock market rally today, people are investing, and of course, Powell still wants to incrementally increase short-term interest rates, which will affect the mortgage industry and will continue to cause tightening in the market. So some things that are going down are car prices, that's used cars, new cars, luxury cars. They're all starting to trickle down in price now. Because of these higher short-term rates, we now have cars that are simply too expensive. And you'll see in that luxury car market, people just simply not be able to afford it. And because they cannot make those payments with those higher interest rates, cars will definitely need to be marked down in order for it to be affordable for the masses to go ahead and buy and get a deal on such a vehicle. With that being said, you're going to see a lot of repos as well, because a lot of people got homes for 3.5%, with rates that are 6, 7, 8%. And they're going to realize that it's just more beneficial to them to rent rather than continue to pay a mortgage on a home that may just be crumbling down on them, right? So whether they have a roof leak unexpectedly or a kitchen sink falling, and they realize that they can't call that maintenance man or woman because this is their first time owning a home or having some type of ownership, and they've put little to nothing in the deal, they may just decide that it's better for them to rent, shack up with someone else, or simply just walk away from the property and let it be somebody else's headache or burden, right? And so for those people who didn't put any equity into the deal and then they're suddenly underwater because property values in their area are going down like a rock, and they don't want to hold on to an asset that is not an asset to them in their lives at this time, they may forego that. Would I personally do that? Probably not. I'd try to fix it up. I'd try to make it work, right? But if people only put 3.5% down, there are going to be a group of people who don't necessarily have the money to repair the home, right? Repair costs that are associated with the home. And so you'll see that they'll either live in a house that is falling apart with that they're living in, or they will just leave the home and say, you know what, I'm not going to pay this mortgage or whatever. And so we'll see a lot of foreclosures in 2023. We'll see a lot of people who just say, wow, interest rates are so high, the home costs so much, my value is dropping like a rock, and my house is crumbling down. There's absolutely no reason for me to live here. Or they may lose a job because of the tightening in the market and not be able to afford such a home anymore, right? And so there's a lot of factors to why someone may decide to forego or let their house go into foreclosure. And we'll see a large uptick in that. Now, I want to caution people, just because you see people posting foreclosures are at an all-time high since 2020 or something like that. We had a eviction moratorium. We had so many things in place to where foreclosures was just simply not taking place, right? Everything was halted People weren't getting paid rent. People weren't getting paid, period. And so there was a ban on foreclosures for a time being. And so one foreclosure could have led to an increase of at 100% or something like that, right? And so when you see things like foreclosures are at a 1,600% high from a year ago, like, bro, nobody was getting foreclosed on a year ago. So now that things are getting back to normal, now that we have adjusted to COVID life, right? We can now see the impacts of that throughout um, our society as a whole, and we're starting to adjust to that, right? If it took 2 years to adjust to it the first time, then it's going to take at least 2 years to now adjust to the new lifestyle that we're living and having to survive within. And so now that things are balancing out and coming back to normal, especially when the Fed is trying to hasten that process, of course, things are going to happen that affect our economy in a way that allows for that correction to take place in its totality. There's some people who simply shouldn't have bought because they probably wouldn't have been able to buy prior to what had occurred throughout our country and states. So that correction is going to correct a lot of that, and you'll see people who were qualified and were ready stay in their homes, and those who were waiting for their time be able to purchase those homes again at a discount. And like I've been saying, debt has been king for a long time, right? Everyone who was saying debt, get debt, debt is cheap, they knew what they were talking about. They got the cheap debt. They did what they could with the cheap debt. All those people who said 3.5% down, 3.5% down on the cheap debt, listen, they probably were right because they were getting their rents paid. They kept having rent increases, and they were able to continue to buy a lot of properties with little money down and still cash flow a significant amount. And now that they've acquired all these properties, they can just hold on to them and gain that appreciation over the years, gain that debt pay down as well, while interest rates are at an all-time high in the last 10 years and inflation is at an all-time high in the last 10 years. You're now seeing that as long as they hold on to that cheap debt, they are getting significantly richer by the day. And, you know, the longer inflation stays that high, the cheaper their debt truly becomes. Because if your debt is at 3% and inflation is at 7.9 over a 10-year period, your debt just gets that much cheaper to pay off. Because if inflation is at 7% for 10 years and your debt is at 3% for 10 years, you should be able to pay that thing off because eventually we're going to need raises to counter inflation. We're going to need an adjustment to counter all these costs. But what cost isn't going up is your mortgage payments, outside of property taxes and insurance, of course. So, I mean, there's a lot of benefits to having cheap debt at that time. However, now, because of inflation and because of this correction, it's going to correct down significantly before it adjusts to its real normal, right? You're going to see a crash, and then you're going to see an adjustment. And what I mean by crash is probably 30%, no more than that, right? People didn't just buy these homes or refinance into these homes to sell it at a significant loss. Unless they really, really need to change states and change jobs, you're not going to see a frenzy like you once did. And then even then, you may see 20% drops where people are nibbling at their chops to go ahead and get this. And that will probably be the new norm. But a 30% drop, although I think is likely, that is probably the max that we'll see in any market outside of California and Arizona and maybe Florida. So in Columbus, I don't expect to see drops of that magnitude. But again, um, the markets rallied today, and that just shows how much money people actually have on the sidelines, right? At 7.9% inflation, people are swimming like fishes into the stock market, ready to pile on and get a piece of that action. They want to be the first in and the first out, right? They're timing the market, they're doing what they do. And that's not the strategy that I'm going to live with. That's not the strategy that I'm going to go by, right? I'm going to ride the waves up and down, and I'm going to benefit from both. And that's just how it is. I'm going to benefit from that dividend income that comes when people take it out. I'm going to benefit from that appreciation when people put it in. And that's just how I'm rocking out with the stock market. But as long as you're a long-term investor, whether that be real estate or stocks, you're going to be just fine riding this wave. And as long as you're saving money, you'll know that cash is king, regardless of this interest rates. When those homes are dropping like rocks, and you don't have to buy it at 450, but maybe you buy it at 390, then okay. Now you're talking. Now you got a somewhat of a deal when that appreciation comes back up and the rates go down slightly. You'll be able to really, really sink your teeth into something. And so when you have a $500,000 house and you only pay 390 for it, it may be worth the higher interest rate for a little while. And so you just got to continue to monitor your situation and understand what's best for you. I am not your financial advisor. I am just some guy on YouTube, but I do understand money. And, you're coming to get that education so that you can understand it as well. So thank you for tuning in. Have a great day. Peace.